On the court or in the markets, performance is everything. That's why Anzo Capital is helping to power your trading game. Now official partner of the Phoenix Suns.
Hello everybody. Welcome to Anzo Capital's live webinar with me, John, Senior Market Analyst. Today I'm going to be taking you through how to take your first professional trade on Metatrader 5. Now, you're probably all very familiar with the trading platforms that are out there at the moment. I think Metatrader 5 and Metatrader platforms in general are probably the most popular platforms that we have. So they are widely used. We have mobile apps, we have desktop apps, but I'm going to take you through the desktop app today. We're also going to have a look at kind of building in a bit of a structure for you. But before I get going, really, if you can hear me, just drop a number 1 in the chat before we really get going. I also just have to say that I have been ill this week, so if I have to kind of like pause for a second, just bear with me. On the struggle bus this week. But I hope everybody's well. I hope everybody's had a successful trading week so far. It's a very important day in the markets as well. It's non-farm payrolls, and I'm pretty sure everyone will be really excited for that one as well. Thank you, Seth. Appreciate you coming in and dropping in the number 1 there, and hello to you. Hope you're well. So we've got non-farm payrolls coming up today. That's going to be a really interesting one. Hopefully soon we can bring you some events as well around those type of news releases, those really important key data points as well, because they are critical into what's going on in the markets as well. Whether the markets will actually take notice of them today, we'll have to wait and see, considering what's been going on in the Middle East at the moment. But we'll soon see how that plays out. But first of all, let me introduce myself properly. My name is John. I'm the Senior Market Analyst here at Anzo Capital. I have been a trader for 8 or 9 years now. Kind of lost track as time's gone on. But yeah, 8 or 9 years. I've been in the retail sort of CFD trading realm for about 6 years. I used to work as a senior market analyst at Blueberry Markets, moved over to Anzo more recently, and I've been featured across multiple platforms as well. And I've also done a bit of work for the 5%ers prop firm as well. So just kind of give you a little bit of my background. I actually started as a retail trader. So, you know, for the information that I provide you over the coming weeks, you know, years, hopefully, I just want you to show that there are many ways to kind of keep yourselves in the markets as well. And, you know, one thing that I learned early on is that I love these markets and that I wanted to stay around them as much as possible. So I ended up getting a job as an analyst, and then moved my way up through the business. So like many of you are probably sitting behind the screen or watching at a later date, looking at this, thinking that, you know, you want to be in these areas. You know, I've been where you've been. I've been on the other side of the screen. I've had a typical retail FX trading journey in that sense. Predominantly my background was in CFDs, have a lot of experience in futures as well. So yeah, hopefully I can bring that experience to this and provide you with some really good information and some really good value, because the goal for me here is to give you a simple, structured, repeatable process that you can use on a day-to-day, on a week-to-week, so that you can perform better in the markets. There's actually a really, really sad statistic, and that is that 90% of people lose their capital within 5 trading days. And that is for a number of reasons. A lot of traders come in, deposit capital into their broker, and they try and grow that money very quickly. And by doing that, they use reckless choices. That may be down to circumstance and things like that. But at the end of the day, that's not going to keep you in the game for a long period of time. And that's the way that I looked at the markets. You know, I've been that person. I've been that person on NFP days where I have taken a buy order above the high and a sell stop order below the low, waiting for the news to come out, being triggered into both and being stopped on both. And living through those experiences has led me to believe that actually trading is more of a long-term game that we can play. CFDs are a product that we can use for certain situations. So, you know, unfortunately at the moment, there is this war going on in the Middle East. Volatility is high. CFDs are a preferred product for most traders in those types of situations because they can use these kind of short-term volatility moves as opportunities. Okay. So today I'm going to provide you with that simple structure. I want to provide you with a simple, repeatable process that we can use on a day-to-day basis. Okay. I want to show you how professional traders think. Okay. And it is that kind of longer term mindset. It's not necessarily about, can I get on, gold and scalp it every 1 minute? You know, whilst that is very popular in the CFD trading space, we can do it, but if we do it in a more structured way, we can make it more efficient. Want to teach you how to control risk. Okay, now this is going to be a big point to emphasize really for ongoing webinars as well. We are going to start doing some more in-depth webinars, and we are really going to do some in-depth webinars around risk, or especially that's something that I really want to try and do as well. I think risk is a very misunderstood topic within the markets. I think everybody knows what risk is in terms of, oh yeah, I risk X amount of % per trade, or I risk X amount of dollars per trade. But nobody really understands the risk in terms of, you know, should you only be risking that 1%, or, you know, what happens when volatility is high? How much should you risk, or should you reduce risk, or in certain elements? So I think risk for me is more of a dynamic thing, whereas a lot of traders will look at risk as just a very static sort of 1%, 2% risk, or a lot of traders just go full blast. The fourth point we're going to go over today is how to actually place trades on MT5. So if you're not familiar with the platform, I'm going to dive into some live charts at the end, and we're going to have a look at some markets. We can have a chit chat as well about some markets if you feel like you want to stick around and have a chat about what interests you. And also throughout this whole webinar today, please feel free to ask any questions. I mean, anything. It doesn't have to relate to the topic that I'm talking about today. If there's something that's on your mind that you want to get some help and feedback on, drop it in the chat, and if I've got time, I'll cover it at the end. If not, we can always reach out and chat to you as well. Okay. So first of all, before we get into the sort of nitty gritty of a simple, structured, repeatable process, we have to understand what we are actually facing, right? What is the market that we're coming up against? Okay. Now the market is just an auction, right? And when you think about it, there's always buyers and sellers going against each other. You know, I've got this graphic here showing you that sort of bidding war. But one analogy that I've always kind of come to terms with is always thinking about it in a bit more of a product focused way, right? So for me, you know, being in England in July, we have this tennis tournament called Wimbledon, right? And it's a really popular tournament, global tournament. It's the biggest sort of tennis tournament, or one of the biggest tennis tournaments in the world. Now, around that time in the UK, strawberries are really popular. Like strawberries are everywhere because it's like the strawberries and cream situation. So I like to think of this analogy. So think about strawberries in July in England, right? Very, very popular across all kind of fruit and veg markets, even in supermarkets as well. So let's say you're a strawberry farmer, right? And you're going to go to direct to market, and you're going to sell these strawberries in the middle of July. You've got 50 packs of strawberries. you know they're popular, so you price them quite high. They're £10 or $10 a pack. Okay. You go to the market store, within the first hour, they fly off the shelf, right? They're gone. That is understanding that you have demand for that product. Okay. So the next day you come back, you have your 50 packs of strawberries. What are you going to do with price? You're going to raise the price of these strawberries. Okay. And you're going to keep doing that day after day until it gets to a point where you're not really selling the strawberries anymore. Okay. So you price yourself out of it. So you could go from sort of £12, £15, £18. And then suddenly at £18, people are starting to second guess whether they start to buy these strawberries. Okay. That's almost a sort of physical version of what happens in markets. You get an area where buyers and sellers create demand for a certain market, okay, or no demand, and we see a little bit of a fall in price. But this demand that comes into the market can raise prices very quickly. But once we kind of get to a price where people think this isn't one that we really want to be buying anymore, they start to sell, or they start to what's known as create fair value, okay, where there's only a little bit of buying and selling going on. And I'm going to show you that reflected on a chart too. But let's go into it in a little bit more detail, okay? So when buyers and sellers are equal, that's also known as something called fair value, okay? Now, I know a lot of traders in here or watching might have heard of something called ICT, right? And you've heard me just say fair value, and you might be thinking that I'm about to talk about ICT concepts. I am not. Put that out there now. I would like to see anybody in the chat who has heard of ICT. If you put a 1 in the chat if you've heard of ICT. Hi, Winston. Hope you're good. Because I wouldn't be surprised if you haven't. But fair value, in the sense that I'm going to talk about, is that buyers and sellers are equal. They just agree on price. Okay, I'm going to show you how that looks on a chart very shortly. Then we have something called an imbalance in the market. And that's when either buyers take over and there are more buyers than sellers. Okay, so usually you'll see price rise in that situation, or you'll have where sellers are more dominant than buyers. Okay, and the price falls off. Okay, that's what we talk about in terms of price going on discovery. Okay, it's trying to discover the next fair value. Okay, so in my eyes, when I look at markets, I will look at what is the market trying to price in at the moment. And usually you'll see this, you can also kind of see this in trading sessions as well. So usually in the Asia session, you'll have a period of what's known as consolidation or a range in market. To me, that's fair value. The market is in that kind of range. When it breaks out of that value and price goes on a new discovery, that's where there's potential trading opportunities. That can often happen in the London session. Or if we see a little bit more consolidation in the London session, it can happen in the US when volatility gets high as well. Yeah, again, we got it right there, inner circle trader. Now, I'm not going to talk about ICT concepts at all. I have been in the game for a while. I've seen ICT go through very different variations, and I'm not an agreeer of their trading style. But when I talk about fair value and imbalance today, I'm not talking about anything to do with ICT concepts. Okay, so what is fair value? So you can see from this line chart here, it's quite clear what fair value is. It's just a slight period of consolidation, or it's a range. Okay, to me, it's where buyers and sellers agree with price. There is not necessarily any buyer or sellers dominating the market, if that makes sense. Okay, now a lot of people try and trade these these fair value areas, and that can be a trading strategy in itself. A little bit trickier to do because it's hard to spot when they're going to end or not. Whereas when we see an imbalance and price breaks out of a range, it's quite easy to spot. So moving on to price discovery, what do I mean by this? So again, you can see from this line drawing here, this is what a market typically would look like. Okay, we'll have a period where the market goes into sort of like this equilibrium of buyers and sellers. We have this kind of fair value that's being built. Buyers and sellers agree on price. It breaks out. It forms what's known as a trend in market, right? That's price discovery. Okay, it's trying to find where fair value forms again. And you'll notice this on a chart. You'll really begin to start to notice it. If you look at sort of like the euro dollar chart on a 15-minute or something, you'll see these areas where you get a bit of an expansion, consolidation, and then expansion again, right? Or you'll get like a sort of a day where we've had a rally, expansion in the day, a consolidation, and then a breakdown of that, right? That's just the market trying to keep finding those parts of fair value, okay? So let's move on to the risks in trading, okay? And I want to talk about the myths. So we've kind of learned about so far the sort of how a market works and the structure of a general market. But we have to talk about risks, okay? And there's some real common myths when it comes to risk that I believe. And you might have heard this yourselves, you know, and you might believe this yourself. So the first one is bigger lot size equals more profit. Okay, let that one sink in for a second. Bigger lot size equals more profit. Now, while technically that does make sense because the higher the lot size you use, the more money you are putting at risk. So if you are successful in that trade, there will be more profit. Okay. But one thing that I just said in there, you are increasing risk substantially. And at the very start, I said that 90% of traders that deposit capital lose their account within 5 days. Okay. So you got to think how many people are coming in just oversizing their position, increasing their lot size aggressively, and they're knocking themselves out. That's not what we want to do. We don't want to do that at all. Okay. Think about it. One sort of analogy I like to kind of put into people's perspective. You know, I'm a big Formula One fan. Okay. They've just had some new rules and regulations coming in this year. So it's going to be quite interesting. But the aim of a Formula One driver is to get that car around the track as fast as possible. Okay. But also as controlled as possible. So they want to do it in a very controlled manner, because if they don't do it in a controlled manner, they're going to potentially spin out, crash, put themselves in jeopardy, put the car in a bad place. They're going to have to spend tons of money to repair the car. So you want to think of trading in that line. There are areas we can identify when it's good to be aggressive. Okay. So for me, I start off very, very small when it comes to a position in trading, right? So if I feel like I've got an opportunity, let's say recently I've been heavily short the pound against the Australian dollar, right? For whatever reason. Pound Aussie has been moving in a downward trend. So on the pullbacks, I've been looking to get in on every pullback. But my first initial position that I got in was of a small size. Okay. Because if it goes wrong, it doesn't matter too much, right? And I can look to get in again. If I was to size in too big too soon, so let's say I put 50% of my capital on at that particular moment, then if I lost that trade, I've lost 50% of the capital. It's really hard to gain any ground again from that point, right? And, you know, let me know if you've also been in that situation, because I've also been in that situation in the past. One of my first ever trades live was in the futures market, and I bought soybeans, right? I bought soybeans. And the reason why I bought soybeans was because there was a commitment to trader report which stated that commercials had been buying soybean contracts at record levels. Now, from the research that I did, I was like, yes, that means that there's a potential turning point. I completely ignored the structure of any technical analysis that came with it, any risk analysis that came with it. I kind of just went all in because I thought I'm following the big boys. I'm following the producers. I'm going to be on the right side of the market. Price just kept falling, kept falling, kept falling, kept falling. Nearly wiped my entire account out. So for me, I learned a big lesson on risk within about an hour. It was about an hour, and it was probably one of the worst hours of my trading life at that time, because I just realized I was on the wrong side of the market, and I realized that I was too heavily on the wrong side of the market. If I had just risked, I don't know, 1% or whatever, and just put a stop loss in, I'd have been fine. But there you go. You got to make these mistakes sometimes, but I want to try and prevent you from doing that. Number two, the second risk and common myth, I would say, is that more trades equals better results. I really don't agree with this one. There are a lot of stats out there, and I've seen a few traders' accounts where they trade a hell of a lot, thinking that it's going to mean that they have a better performance, but very rarely that is the case. You need a very high win ratio if you're going to take more trades and have a better result. And you might be that might put you in the scalping round, but even scalpers, I think, can find it very difficult to have an excessive amount of trades unless you have an EA bot running and it's purposely built to do so. Then as a human element in between can be very very hard to do. I very much believe in sort of a quality over quantity style of trading. The third one is no stop loss equals more control. That is the biggest myth, I think, of the whole session. No stop loss equals more control. The amount of traders I actually see not using a stop loss is incredible. It's one of the most dangerous things you can do. I just told you about me not using a stop loss on soybean futures, and it was one of the biggest regrets I had. I lost a lot of capital that I worked very hard to earn. Right, this was live capital. I put it in myself, and part of it was also from family, which made it even worse. So using a stop loss, critical. I also believe in kind of active trade management as well. So to a sense, my normal stop loss is going to be somewhere where I know that I'm definitively wrong at that point. If price goes through these certain technical points, I know I'm definitively wrong. Okay. Or I might be a little bit early to the move, or I might be very late to the move. Right. But I know at that particular point is, okay, maybe I need to rethink this, wait for technicals to play back out again before I start getting back involved in the market. From this, though, I also have kind of like a mental trading plan in terms of where is the conditions changed. Once the conditions change, are we really in this space anymore? And I can show you an example of that I did last year, right? I was short pound Swiss, was up an extreme amount of money, and pretty much gave the entire move back because I was adamant that it was going to continue rather than just watching the conditions change and just getting out and looking to get back in again. And I'll show you that on the chart. So let's go into the two types of traders that I think are really out there. Trader A, hands up if this is you. I don't know whether anybody would ever want to admit this, but Trader A trades emotionally, changes rules mid-trade, and focuses on profits. Okay. And that is how I started. I was a very emotional trader, very, very emotional. I would take it very personally if I lost a trade. I'd be that kind of person that would really put it on themselves, okay, and be like, you're not good enough to do this, X, Y, and Z, okay? I was that person. Over time and with experience, I'm very much trader B now. I trade with a very, very strict plan. I prioritize risk first, risk over everything, and then I focus on the execution. And that is how you can go from being a trader that is emotional to being a trader that isn't necessarily too emotional. Now, obviously, I still have my tendencies, and sometimes my thoughts still get the best of me. That's just human error, okay? But what really changed for me was adding some kind of structure into my trading plan, okay? It was kind of like, okay, I need to really think about how I set a trade out. What is the idea that I have? Do the conditions match it? And what strategy can I use to apply to get the best out of it? That is it. That is what I kind of tracked it down to. And you can work backwards. What is the goal? The goal is to make money, right? The goal is to make money with as little risk as possible. That is the goal, right? But working your way back from that is, okay, well, if I want to do that, what do I need to put in place to be able to achieve it? Well, I'm going to need a strategy that is proven to work in markets. So go and find a strategy that's proven to work in markets. Then it's about, okay, well, when is that strategy the most efficient? Okay, what conditions make it most efficient? Okay, well, why am I even trading that market in the first place? What conditions were created in order for me to apply that strategy in the most efficient way? Well, we need to look at the why. Why did that market move the way it did? All right. And that's putting plans in place and giving you a structure. Now, I've coined it the WCS method. It's something I made up myself, which was why conditioned strategy. I just called it the WCS method. And I will teach you a more in-depth that on a future webinar. Okay. But let's have a little conversation about risk. Okay, let's have a little conversation about risk. Now, this you might think, oh, I'm sick of risk, sick of, risk can be boring. Risk, if you want to be serious and you want to be a very successful trader, the one thing that I've learned over the years, and I speak to a lot of traders as well. I used to do a lot of trader interviews, still speak to traders now. I also am very fortunate to have a couple of phone numbers of some of the guys at a couple of top hedge funds. I also have a couple of numbers of the guys that have these big algorithms that have 80% win rates and stuff like that. So I'm very fortunate to be able to have a network of people that I can talk to and build up this plan of, what is risk? How much should you risk per trade? Now, as a new trader coming into the markets, I always say you're better off starting small. You're better off starting small. You might want the Lamborghini lifestyle. You might want to think, I'm going to go buy a Lambo. I'm going to change my life in a day or in a week. But when something sounds too good to be true, it generally is too good to be true, right? So if somebody says to you, you're going to be able to put this money in this account, quadruple it, 10x it, 100x it overnight, which is possible. But as somebody who's new, who's never been in the markets before, it's just not ideal. Okay. I have seen it happen and, they've lost it within a week. It's almost like lottery winners, right? When somebody wins the lottery, there's a statistic, and I think it's something like 60% of them lose all of their capital within the first 10 years. So, and it could be millions. They can win millions, right? And then 10 years later, they're left with nothing. And that's all about risk management. They want the fancy lifestyle because they've got the millions. Really speaking, they could just invest half of it and probably live off the interest. But it's interesting. Anyway, enough of me babbling on. This is something that I do, and you'll get to know this. But how much should you risk as a new trader, right? I think 0.5% is plenty. Okay, now you see the common ones are like 1 to 2%, things like that. I actually think risks should be dynamic the more data that you have. Okay, so I've put a little note here just to say once we reach 100 trades, we have data that we can use to understand our averages. What I mean by that is we'll understand our average win rate, our average loss, our max drawdown, and we'll understand sort of when the best day to trade is, what our top performing asset is, and all these kind of different things. And once you have a bigger picture and the more data that you have, the better you can make a decision. Okay. So for instance, you might find that within your data that you're better at trading high volatility markets. And in the low volatility markets is where you lose more than you gain. So you can eliminate those and add that into your structure of, okay, well, when it comes to risk, I know that I have in high volatility markets, I have a 72% win ratio. So that means that I can risk X amount percent without going bust. Okay. I know my average loss. I know my average win rate. I know my risk reward ratio, all this kind of stuff. Okay. But the more data you have, the better. Before you get that data, though, you've got to put some skin in the game. Okay, you've got to get some skin in the game. So I would just go as light as possible. Micro lots, nano lots. I would not go anywhere near a full standard lot if you are very new to the trading, unless you have obviously a large capital amount. Okay, so just think about risk a little bit before you go and apply it. So in this method as well, like I said earlier, I want to try and teach you a simple, sort of structured, repeatable trading method as well. So there is a strategy that comes in this webinar, but we have to talk a little bit about understanding order types. Okay, and there's multiple different order types, and this kind of plays into a little bit of risk as well, because there are actually 6 types of orders that you can apply using the Metatrader platform. Okay, you have market orders. Now these get us into the market immediately, right? So that's like you've gone to the farmer's market, they're shouting it's £10 for your strawberries. You're happy with that. You're like, yeah, I'll pay that exactly right now. All right, that's what a market order is. Now, a pending order is something that is used more frequently and is more of a sort of trait of somebody who has more of a kind of structured plan. Okay, you want to get in at a particular point. So a buy stop order is usually is placed above current price levels. So you really want to be taking in on the momentum. Okay, a sell stop order, okay, is when you put a price level below where current price is. Okay, your entry is below where current price is. You want to be taking in with the momentum to the downside. All right. And these are the 2 that we're really going to be looking at going forward in this strategy. Okay. We never really want to use market execution orders as a beginner, because we want to be able to make sure that our risk is appropriate. And sometimes when you're a new trader, you don't understand risk, you don't understand your lot size. It's harder to kind of make sure everything is in order before you place a particular trade. Okay. So this is what we've covered so far. Just to kind of give you a little recap, we've gone through what a market is, how it actually works, and we've gone through the auction process, what fair value and price discovery is, okay, and how that impacts a chart. We've gone through the risk in trading as well, and we've also gone through the order types. Okay, I'm just going to have a brief moment just to have a drink. Now, we're going to be moving on to probably the exciting part now. I've took you through the parts that most traders find boring, but sometimes you got to live in the boring to get better. Okay, it's like taking a course on anything in life. If you wanted to be a doctor, right, you wouldn't just dive straight into being a doctor. You would have to go through processes. You have to go through education to become a doctor. Okay, think of this and these webinars as your education to becoming a better trader. Okay, so let me know, guys, if you can still hear me. Drop a 1 in the chat if it's all understandable so far as well. If there's any questions as well, like I said, please feel free to fire those in. You might see something on one of those charts there and think, I don't know what that means. If you want to ask me about that, please feel free to do so. There are no wrong questions or no silly questions in my webinars. All right. So let's dive in then. Let's have a little look at a simple trend-based strategy. Okay. Now, what are we going to be using? Now, yes, I'm going to be using some indicators, right? But I'm going to teach you about price action first. Okay. And price always comes first. So we have a simple trend-based strategy. And it's actually a strategy that I've been teaching a lot of the guys behind the scenes here at Anzo as well. So if you want to contact some of the CX team, they will happily kind of chat to you about trading strategies, because I've shown them a couple of these strategies as well. So we're going to use a multi-time frame trend-based strategy. What does that mean? It means we're going to use multiple time frames to find the best trading condition. Okay, we're going to kind of ignore the why side of the WCS method today, because there are a lot of many whys that you could have for a trading idea. I'm just going to stick to the technicals today, and we'll discover a why in the future. And I'll show you some live action that we can pull upon as well. So multi-time frames is just using multiple different time frames to agree with a condition. Okay, we do this because it increases probability. Okay, and it increases the efficiency of the strategy. All right, we're going to be using a 50 exponential moving average. We're going to be using a 200 exponential moving average for trend direction. Right, so we're trying to line all these time frames up before we execute. And that's what our aim is. That's what we're trying to do. Now, I am going to use a ADX Wilder just to confirm trend. Now, this isn't mandatory for me. This is just something that I added on as a potential visual aid. Okay, it's not something that is detrimental to this particular trading strategy, but I just put it there as a visual aid so that you can kind of see what potentially we're going to be looking at. All right. So we're also going to be looking at the stochastic oscillator to show us an overbought, oversold condition. Again, just to caveat this, all indicators are lagging. Okay, what that means is they are produced by price. So price happens and then it computes, gives you an indicator, right? So price is the real sort of truth. An indicator really is just kind of like confirming what you're seeing in a way, right? So think about it like that. We don't really rely too heavily on them, but it's part of a strategy, can help you be consistent. Number 6, we're going to use buy and sell stop orders. Buy and sell stop orders only. That's all we're going to be using. We're not going to use any kind of market execution today, okay? And we're going to be using 0.5% risk per trade. Now, that's if we go down the routes of actually seeing something live, okay? If we see something live, I'll look to potentially take a position in the market, all right? Hopefully, I've got my account logged in to do that. So what is the strategy? What is the strategy and how does it look from a live perspective? Let me just kind of expand this out a little bit so you can see this in a little bit more detail. So what do we have? We have a 15-minute chart on the left-hand side. We have a 5-minute chart in the middle, and we have a 1-minute chart on the right. Okay. So the 15-minute chart is our higher time frame. Okay, that's the chart that we're going to be using to kind of build in our conditions of what we want to see into the market. The 5-minute chart is also going to be there just to kind of help us make sure that that is also kind of in a position where we want to take a trade. All right. The 1 minute is where we're going to execute. Now, it doesn't have to be these time frames. You can go through like, let's say weekly, daily 4 hour, or daily 4 hour, 1 hour. But we always kind of want to use three time frames and like a 3-step method where the higher time frame is always going to be on the left hand side, our middle neutral time frame is going to be in the middle, and then our trading time frame is going to be on the right. Now I'm just going to use the minute chart for these examples because charts are going to be moving and we can have a look at some potential market movers and kind of what's happening now as euro dollar kind of plays around a little bit. Okay, so when does this strategy work best? So this is where I talk about, okay, we have the strategy, but what conditions does it work best in? Is it going to work well in a ranging market? No. Why? This is a trend-based strategy. So if the higher time frame is in a range, are you going to be looking to take a position? No, we're not going to be looking to take a position. So if the 15-minute was, let's say on the bottom left-hand side of this chart here, you can see there's a range in market, or what we know as fair value, right? Price is ranging. Are we going to be using our trend-based 1 minute strategy to buy? No, just doesn't make sense to do so because price is chopping around. We don't know how long fair value is going to be agreed for. Okay. When it breaks out of that, that's where we're going to be looking to potentially get into a move, because that market is then kind of on that journey of price discovery. Then we have a little bit of a pullback, and then we have a continuation. Now, the sweet spot really is when we transition from being in that sort of impulsive phase, pullback phase, back into the impulsive. So when that pullback starts to turn and starts to give us signs that we're going to see that move back higher, that is that sweet spot for us. And that's something we want to try and find when we're looking at the higher time frame, especially. Okay. So you can see from this chart here, it's going to be better performing in those trending environments. So let's have a little look at a buy trade example. Okay. Now what I might do is, let me just see if I can do this on here. I might just present my screen. Which I think is this one up here. Okay. Let me see. Let me remove this one, add it to stage. Aha. Yeah. So you should be able to see this now. And what I'm going to do is I'm just going to grab a pen tool just so we can have a little look at this buy trade example. Okay. Now you might think our trend strategies, they're not sexy, and they're not. They're really not, but they work. They do work because strategies in trending environments are just pretty easy to use. Okay. So what you can see here is our 15-minute time frame on the left-hand side. Okay. Our 15-minute time frame is in a trend. We can see that we went from being in a sort of downward trend, making these kind of like lower highs, lower lows, into a bullish trend. We break, we make a new high, right? The market then starts making higher highs and higher lows. Okay. So we want to really try and trade when that higher low starts to sort of transition, okay, and become into that kind of move here, right? Now, I usually call these phase ones, and the pullbacks are usually called phase twos, but I won't get too much into detail of that today, right? So the ADX Wilder, what's that showing us? Well, above 25 usually states that we are in a trending condition. Okay, so you can see how this is kind of lagging behind, because where I've put this line here, you can see that actually we can agree that when price makes this new high here, that is usually a good sign that we're about to change and we're about to go through another trending phase, right? But on the ADX Wilder, from a visual perspective, that's where we can see. All right, and that was at 2 p.m. Okay, Metatrader time, so about midday for me, on the 27th of January 2026, and this is on euro dollar. Okay, all right. Now we can see, and this works for gold too. But if we're looking at the buy trade example here, what we're looking for is those areas where price pulls back to the moving averages on our 1 minute time frame. We can also see that we're agreed on the 5 minute, we're making higher highs and higher lows, right? These are our buy trade opportunities, okay? Where the market comes back into the moving averages, breaks above the average. So we could look at putting a buy stop above that candlestick high here, stop loss below the swing low, look to target an area of resistance, okay? Same here. Market breaks back above the 50 moving average. We could put a buy stop order here, so it only get triggered on this candlestick here. Stop loss below the swing low. Look to target an area of resistance, or look to try and get a ratio out of it, like a 2-to-1 potential trade. Let's look at a sell side example. Okay, and the market has been selling off quite aggressively recently. If we look at different types of markets, including gold, gold has actually had a bit of a bearish period as well. So this is the NASDAQ. We can see that the 15-minute chart is in an aggressive sort of downward trend here, making new lows and pushing lower. The ADX Wilder confirms it with a move above 25. Okay. What happens on the 5-minute time frame? Well, you've got the lower lows, lower highs. Okay. Now, these kind of areas here, these lower highs are where we can get some trading action, right, on our 1-minute time frame. So the 1-minute time frame, what does it do? It breaks back into the moving averages here, closes below the 50 moving average. We have a stochastic oscillator that was in the overbought scenario. Sell stop under here, stop loss above the highs, follow the trend down. Okay, really simple trend-based strategy that you can use. And what you're doing is you're matching your time frames up. Okay, you're looking for your 15-minute to be in a trend. That is your conditions. Okay, alongside your 5-minute. Right, that is the conditions. Your strategy is to wait for price to come back into the averages, okay, into an overbought or oversold condition, and then look to trade. All right, really, really simple, and you can use it on multiple time frames over multiple different assets. So let's go and have a little look at this. So I'm actually looking at euro dollar right now. Let me know what chart you want me to use. We don't have to use euro dollar. We can go and take a look at it on multiple different assets as well. But we're going to go take a look at this on a screen as well. Let me just move the slides over. And I'll bring in the charts. Here we go. Right, so this is the euro US dollar chart live. Okay, you can see that we're live right now. And this is the situation we've got ourselves in. So let me just pop this on here so you can see the ADX Wilder there. Let me just remove the tick volumes. I'm just going to expand these out a little bit as well. So there was potentially a little bit of a trade here going on. And there was a couple of opportunities yesterday as well that I can take you through. Right. But let's have a look at current price. So if you're not familiar with the Metatrader platform, you know, and you want to know how you can kind of split screen the 3 charts here, really, really simple. You just want to make sure that you've got 3 charts open. Okay. So if you go to your sort of market watch in your terminal, okay, you can do it by Control M or anything like that. If you right click chart window and you do that 3 times, you can do it for the same asset. Okay. So if you wanted like 3 charts of gold, right? You come down to gold, hit 3 charts of gold. Okay. All right. Let's say you don't want euro dollar. You could just X these off. Okay. Close that one as well. And then all you do is you see these little tiles at the top. Looks like a window. All you do is click that window. Okay. And then you can have them set up like this where you've got 3 in a row. You can do 4, 5, 6, doesn't really matter. You can have all the windows open if you want. Don't recommend it, but something you can do. And obviously you can have templates. So I've got my 15-minute strategy template in here. And then I've got my 1-minute strategy, which I can apply. Okay. And then all we've got to do is cycle through the time frame. So on the right-hand side, we want our trading time frame. For this example, it's going to be the 1-minute chart. Okay. And make sure these 2 buttons are clicked up here so that it takes you to current price. And we do the same here. So we want a 5-minute chart here, take me to current price. And then we want a 15-minute chart here, take me to current price. Okay. Very, very simple. Very, very simple. And you can see there was actually a couple of opportunities potentially on gold today, right? Already. Let me just zoom out a little bit on the 1-minute chart. Look what we had. We had 15-minute trend developing on gold, right? We've got a 200 moving average and a 50 moving average on the screen as well, like I explained earlier. The 50 is the grey line, the 200 is the orange line. 50 below the 200, we're looking for sells. Okay, we're looking to sell. What do we need for that condition? We need lower highs and lower lows. Okay, lower highs, lower low, lower high, lower low. Okay, and what we're trying to do is trying to then find a position within that. Now, the 5-minute time frame just gives us a little bit more in-depth look into that. Okay, and you can see here we're starting to match up. We've got that crossover and a potential opportunity. Okay, now the ADX Wilder is kind of pointing down. The reason why that is because it's had these kind of upward trend moments. So that won't really change until we start really creating significant lows, although it's starting to kind of make that move now. But you can see it was like this earlier as well. We had this kind of section here above 25. But like I said earlier, the ADX Wilder is not sort of definitive. You don't have to use that. But it's just a good visual aid to keep you on side. But you can clearly see by price action, it's making lower lows and lower highs, right? 5-minute chart is doing the same, making lower lows and lower highs. Okay. Now look at the 1-minute chart. Okay. So when we kind of really started breaking into new lows on the 15-minute, it was around this time here. Okay. So it was around 8 a.m. Metatrader time, which is around 6 a.m. UK time or GMT. So that'll be like 7 a.m. for you if you're in Nigeria. So you can see that the market is breaking down around about that 7 a.m. So if I pop that here as well, so this is 8 there, okay? And then you've got the 1-minute chart as well. I don't know if I'll be able to go that far back without getting rid of all of price, but where's 8 is here. Okay. So you actually have a lot of potential trading opportunities in those different areas, right? So you've got things starting to match up at 8 o'clock where the market's making lower lows and lower highs with the averages saying that we're on the sell side of the market. We can agree here because on the 5-minute, we're starting to get that kind of price action. On our minute time frame, we have the 200 above the 50 moving average, okay? And our first potential trade opportunity comes here. We have the market in an overbought condition on the stochastic oscillator. We have price in the averages. It closes below. What we can do is enter sell stop order, stop loss above the highs, okay? And then we're looking to try and target areas of support and resistance from the previous areas of consolidation, or however you want to use your risk reward ratio. Okay, market pulls back in, we get another idea here. Okay, so we have that moving there, another signal technically here. Okay, another signal here, and one more down through here, but we don't really get the touch of the averages, I don't think, unless it's that one there. Okay, so really speaking, you could have had 1, 2, 3, 4, 5 opportunities on gold this morning alone, right? 1 would definitely be a winner in my eyes. 2 would probably be your loser. Okay, if you put your stop loss above that swing high there, you would have been stopped out. If you put it above the main high, you would have been in the game. 3, you would have been entered here. Stop loss is above the high. That one's a winner. 4, stop loss is above the highs. Winner. 5, stop losses above the highs. So for the day, you'd have sort of a 90% win ratio, right? You'd have had 5 total trades, 4 winners, 1 loser. Okay, that's meant to be a 1, not a 2. And that's meant to be a 4. It looks like a W. So here you can see it's kind of a really simple, repeatable, trend-based process. It's about finding the conditions that are best suited for your trading strategy. And that's something a lot of traders don't do either. They don't have a strategy. They're just going to guess, right? They come to the charts, they look at the chart and they go, I guess this is what I'm going to do today. It looks a bit bullish. It looks a bit bearish. It looks like this is going to happen. Try and eliminate that as much as possible, okay? What is the chart doing? What is it doing? Okay. What is it making lower lows and lower highs? Yes. Brilliant. We could go short. Does the trends align on the two main time frames? Yes. Great. Do we have a strategy we can apply? Yes. And it's about building that kind of structure into your trades rather than just going in blind, going and guessing what could happen. Oh, I heard my mate down the road is saying that gold's a buy. I'm going to go buy it. That is not realistic. Okay. It's not realistic. We have to really start thinking about what we're doing to in order to maximize our trading. Okay. Now I've just realized that I've gone on for an hour. And I didn't think I'd go on that long. I thought I'd go on for at least 40 minutes, but this is what happens. I'm quite a passionate person about the markets. So, I get into it a little bit. So if there are any questions, please let me know. We can use this time to have a little chat around about markets as well. If you do want to stay a little bit longer, that's absolutely fine by me. So if you do want to sit and stay, have a little chat about markets, let me know. Marcel's asked for Aussie CAD. What about Aussie CAD, Marcel? Why do you like it? Let's get into that. Why do you like it? So I'm kind of liking the price action here on gold. If you look at it, technically we have a little bit of a setup going on here right now, right? There's a potential for the market because if we look at our 15-minute time frame, we have a lot of consolidation down here. Now, what is that consolidation? It's fair value. Okay, this is fair value. We have a imbalance. Buyers took on that imbalance. So there must have been I guarantee there was some kind of either news or some kind of, that might have been the sort of open and the close of the session. But there was some kind of imbalance here which drove prices aggressively higher. Okay. We then double topped, very common trading pattern in the world, or at least an equal high here. And we break out of that. Market makes new lower lows, lower highs in line with the predominant trend. Okay. You can see prices going from the top to the bottom, right? Predominant trend is down. Real simple way to do it. This is a great question. So Aki says, do you recommend day trading or swing trading for beginners? I am definitely on the fence with this because I think it actually comes down to your sort of personality as well. Some people are just naturally good at day trading, whereas swing trading I think is easier, especially because a lot of traders are doing this with other jobs as well, which I do recommend. I don't recommend anybody kind of quit their job and go into trading, which is bizarre really, because that's exactly what I did. So I quit my job and went directly into trading, but I do not recommend. It puts a lot of pressure on you. And I was young enough and dumb enough to do it. But yeah, I would say if you are a beginner, swing trading is definitely more of a method because it helps you get used to the flows of price, and everything is fractal. So if you get really good at being a swing trader, then it's easier to transition to a day trader because you kind of know what you're looking for. The only thing you've got to then get familiar with is the pace of how it plays out, and realizing that if you're day trading, you're probably going to be taking multiple trades a day versus swing trading, which you're probably going to take like 2 or 3 trades a week, right? And that's more my style. So I'll show you a little bit. Let me bring up my my other chart and just show you kind of how I would usually look at a particular market. I'm just going to use TradingView just to quickly just kind of go through and show you those points. Let me just jump on it. So like I said before, pound Aussie has been a market for me that has been very trend based. Okay. I think we actually posted in our newsletter, if you are an Anzo Capital which you should be. Client, I actually took my first trade up here. Sorry. Stops above the high. So you can see the predominant trend here, right? Now, this is a classic way you can swing trade, right? Now, this is from the start of the year, and I've had about 4 or 5 trades on pound Aussie this year to the downside because there's been this really strong trend. Now, why has there been this really strong trend? Okay, so if we're looking at it from a why, and this comes down to strategy as well, because really that's part of what you're asking me there is, do you recommend day trading or swing trading? That is part of a strategy. Are you going to use lower time frames or higher time frames, right? And if you are, how does your strategy perform in those environments? You know, it all comes back to the data. So why was I so passionate about going short pound Aussie, right? UK central bank cutting rates, or on the very, very edge of cutting rates. Why are they trying to do that? Unemployment is climbing. Growth stalling. So they want to try and cut that because ultimately that leads to inflation falling. Okay. On the opposite side of that, you've got the RBA. Inflation is sticky and unemployment is falling, which is positive. They just had quarter-on-quarter GDP figures as well, which, you know, came in better than expected. Right, so Aussie was a positive. So that's my why. That's my why I'm short this market. Now, I am a little bit on the edge of whether this will continue or not, because there are some suggestions that it might not, or it's just a bit more of a riskier play now. But let's have a look at the conditions. What are the conditions giving me the idea to do that? So I actually posted this in a newsletter a while back, and it was this moment here. And this is where we were. We were like here on the chart. And I said, well, actually, if you look at the chart from a technical analysis point of view, price is trading below the 50-day moving average. It's usually a sign that price is pretty bearish. We are also forming a triangle pattern, right? Where we have these lower highs, which is really crucial, right? Price is making higher highs, we're more likely to be bullish, but we're making lower highs at this point, right? And what I looked for basically was this resistance zone in here, and I took a short in and around this area here. Market came down, okay? Breakout. So we've got these conditions that are saying downtrend, right? We've got bearish price patterns combined with trend and the 50-day moving average, lower highs, all this kind of stuff, considering that we're in a downtrend. The strategy for me was waiting for breakouts of what I call the P2 to P1, right? P2 to P1, P2 to P1, right? I'm looking for those transition points, P2 to P1, down in there, all right? And I'll go through this in a bit more of a webinar in the future because I kind of run out of time today. But yeah, we'll go through that another point. But that's a great question, Aki. I really appreciate that. For beginners, definitely swing trading for me. But that is just my opinion. Okay then, guys. So thank you very much for joining me today. There are some things that are potentially coming up in the future where we're going to be giving you guys some rewards for coming to the webinars and things like that. So keep your eyes peeled for that. Thank you very much. I'm going to leave it there. Enjoy the rest of your days. NFP is coming up later for the guys trading, so be careful. It's going to be an interesting play, but I'm going to be watching that very closely. And thank you for joining me. And yeah, speak to you soon. Thanks, guys.
On the court or in the markets, Performance is everything. That's why Anzo Capital is helping to power your trading game. Now official partner of the Phoenix Suns.